Well, 2019 was a good year for EML payments as shares surged 200% and it had acquired Ireland's prepaid financial services group for $452 million. But the deal came with a whole heap of debt, and then the coronavirus set in, sending shares crashing from $5.20 to $1.20. In reality, it was also the debt that was associated with that acquisition. But management has been putting in the hard yards, and to get us up to date, its CEO, Tom Cregan, joins us now. Tom, welcome to AusBiz. Great to have you here with us. Do you feel like you've been through the wars? Tell us when things were really bad and when you realized over the past couple of months that things might actually turn out well in the end, fingers crossed.
Yeah, it was an interesting period. There's no doubt about that. I think within a space of 2 months, 3 months at most, we closed that deal at the end of November and would have had pro forma EBITDA of 85 million, free cash 55, 60 million. And so having 120 million of debt was a pretty conservative leverage ratio. But coronavirus just threw that up in the air completely, and for us actually was an opportunity to restructure it. We had the opportunity to walk away. They had the opportunity to walk away as well, but we decided to stick at it and just restructure it so that the end result for EML shareholders was the best one we could do, and they own 8% of the company. So clearly they wanted the same outcome as every other shareholder did.
So Tom, let's back up then. Tell us a little bit about your company and why, I suppose, the wind really got knocked out of your sails when coronavirus hit, because you are leveraged to international markets. You're leveraged to retail spending, essentially.
Yeah, in some part, yeah. I mean, we're a B2B payment platform, so including the PFS company, we've got 3,000 plus programs in operation, and they cover all manner of industry segments, from retail malls to gaming to government spending to welfare distribution to salary packaging, etc. Malls were about half of that, so our revenue and earnings that came from retail shopping malls were about 55% of total earnings, and obviously they're all closed. So come probably from March 10 onwards, when you had mobility restrictions in Italy and the UK and France and Spain and other markets, that tapered off, and then in April they were substantively closed. In May they probably will be as well. So the price reacted pretty sharply to that. I think the double whammy though was the expectation that the deal would proceed, with all of the debt, and that there probably wasn't the ability to renegotiate that. But when you're negotiating those things in private, it's not really appropriate to talk about it in public. So we had to let the rumour mill and the speculators have their way on the stock and just keep focusing on what we were intending to do. But yeah, no question. The impact of the malls side of the business is significant in the short term. Luckily, and it is certainly a degree of luck, this is the lowest quarter for gift cards in a given calendar year. The bulk of them happen, in the last week before Christmas. So had coronavirus happened in November, December last year, it would have been more significant than what it is now. But that's just pure luck and timing, I think.
I guess that is somewhat of a silver lining there. But if we're looking to maybe the growth plans, the optimism ahead, what is it now that EML is planning to do, maybe outside of this scope of malls? There's some economists who say that we're adjusting to a world of more debt, less globalization, but more digitization, I should say. There's a lot of markets out there, such as in Africa, other emerging parts of the world with no access to bank accounts. Is EML going to look for these new opportunities to grow its business?
Probably not in Africa. I think we've got a fairly... but we're in the US, Canada. We're looking at different parts of Latin America, Australia, obviously, and then Europe. But I think they are the geographies that we stay, pretty much focused on for now. The digitization trend is significant, has been significant for years, but will become more pronounced. I've got no doubt. We have signed. I'm just trying to think now. Probably between us and PFS. something north of maybe 15 to 20, contracts with companies that are looking to adapt and use digital payments in their business in one way, shape, or form. So some of those are in market, some of those have been signed and will be launching, and they cover really every industry, everything from buy now, pay later services to lending, to gaming, to telecoms, to everything else. So you've got a lot of companies now that are looking at how they embrace payments. For all the doom and gloom of COVID, which is justified on the health side, companies like ourselves and others are really looking at what do you want to look like in 2 and 3 years' time, not how do you get back to the way you were. Malls were half of our business, but that doesn't mean malls need to be half the business in 2 years. You probably don't want them to be. Maybe there's an inexorable shift now towards online purchases, and mall volumes don't get back to where they were, or maybe they take some years to get back to where they were. Our focus is fully on how do you reimagine the business, and in all honesty, we've never been busier. It's quite counterintuitive to be so busy with so many new opportunities and projects amongst a kind of a health crisis like we're seeing. But it's driven by other companies that also have more time on their hands than they would normally have.
Yeah.
To innovate as well. I mean, normally our customers in their different segments, are working hard on day to day. When the day to day gets disrupted, then they've actually got the time to reimagine their own business, which creates opportunities for us. But I think that the shift to digital has been going on for a while. I think now it just becomes, significantly pronounced going forward.
Tom, just quickly, I mean, is it once burnt, twice shy? Would you shy away from making any big acquisitions for the foreseeable future?
No. I think we've always been a company that has always seen a balance between organic and inorganic. It's just part of what we do. We've done numerous small acquisitions. PFS is certainly the biggest. I think that needs a bit of time to digest, frankly, just to make sure the execution of that works well. And I think that from a messaging point of view to the market, when we restructured the deal to give us $120 million worth of cash on the balance sheet with no debt, we did that for a reason, to be able to survive unknown economic circumstances. To then go and spend that on an acquisition, I think would be really confusing to the market, who would say, hang on, a week ago you had 120 in cash and now you've got zero. So I think for now we won't be looking at any kind of large scale deals, but we're certainly looking at other smaller companies where we can innovate, partner with them, incubate them in some respects. So the biz development cycle and the product cycle never stops. It might just be more more in-house and less on the M&A front for 12 months or so.